In today's video, I am going to be talking about two stocks that I would be buying right now. Actually, I am buying right now that pay a little bit of a dividend. And guess what? They are literally the best hedge against inflation. So let's get down and let's check out these two amazing companies. First is Visa. Visa, of course, is a credit card. Now, why would Visa be an amazing choice right now, especially with inflation coming about? Well, actually, when inflation hits, everything costs more money. Everyone's going to be using credit cards. They already are. And if they're not, they're probably going to have to be forced to do so because they're just going to need to pay for stuff somehow. So, how does a company like this make money? Well, of course, they make money on interest. That is obviously a massive portion of their business. They charge between 20 and 30% on average. So that's huge. But what else? Well, guess what? The more money that you spend in store or online or wherever you're using that credit card, they are making more money because they take a small portion of a percent on every transaction. So if everything has gone up, let's say 10% year over year, so it's costing you, the consumer, 10% more, guess what? They're making 10% more money. That's just automatic. That happens. And then if you can't pay the credit card bill, they start making money on interest. So just insane. If stuff costs more money, they make more money. Why not buy them? So what's their dividend? Their dividend is kind of small at 0.75%. So it's not something that is a massive part of course, this stock, but it is nice to get a dividend. Their volume is huge. So of course, it's going to be very liquid, very easy to get in and out of. I'm going to compare the PE ratio as well as market cap and their 5-year monthly beta in a second, but it has to be compared to the next company that I'm going to talk about. If we look at their chart's kind of interesting because let's say we look at just past 2020, which is of course that massive drop that everything had. Since then, it's now dropped below that point right there. Since it's dropped below that point, it's pretty well found a bottom. Now, the interesting part to me is the fact that now it's trading right here. If it falls below this line, that could be, of course, a bad sign. But if it starts trading back up and gets above, this could be quite interesting of a stock. And they do regularly increase their dividend as well. They just recently did that just over a year ago. Now, Mastercard is the other business. Now, of course, these two companies are basically the top two credit card companies in the entire world. Mastercard and Visa have a massive portion of the market. So, let's really compare their actual market cap and their beta. Also their PE ratio as well. I always like to compare PE ratios, price to earnings. So if we look at MasterCard's PE, it's 31.7 versus Visa's at 28. And then market cap is 302 billion and beta is 1.06. Visa has a bigger market cap. However, the beta is a bit lower. So this actually technically trades under the market while MasterCard trades above the market, but they're so close to one that, of course, it doesn't make a massive difference, in my opinion, but of course, it is something to take into account when you're looking at these two stocks. The dividend of Visa is 0.77, MasterCard's is 0.62. That alone could technically affect the beta in a way because, of course, people who have their ability or have it set up in their trading app or their trading program to be able to reinvest their dividends. And if Visa's is higher, then technically it could help MasterCard in a way where maybe with MasterCard, more people may be reinvesting into the business, things like that. So that can be a false flag kind of idea when it comes to, of course, the dividend. PE ratio is what I really like to look at, and right now technically Visa is cheaper. They both have millions of shares traded per day, so of course that is something else to look at. They're both very liquid. Both kind of similar when it comes to their stock price, their charts. However, we can kind of see a pattern that is starting to kind of show up. A little bit of a downwards trend, some sideways trading action as well. So, of course, very interesting. They do, of course, again, continue to push up their dividend. They continue to raise their dividend, which is something that you want to see in a business that shows that they are making money. Now, when it comes to their earnings, if we look at MasterCard, they've had 3 beaten quarters. They've beaten each quarter pretty handily, and they have increased their revenue as well as their earnings, which is what you want to see in a business. Now, with Visa, again, 3 beats in a row. They have also increased their revenue and their earnings as well. So when things cost more money, who makes more money? Technically, the credit card companies. That is a major investment right now, in my opinion. This is where I'm kind of looking at right now when it comes to inflation and who is going to benefit. It's going to be the credit card companies. I hope that you've enjoyed today's video. If you have, hit that like button, subscribe, and I'll see you guys again next time.